Today, my colleague Sasfin and myself will talk about low risk investing. Sasfin BCI stable fund, what are we trying to do? Our objective is inflation plus 4% per annum, but with low risk. We have a core of fixed income assets with addition of equities, maximum of 40% in terms of the CISA regulations. We risk control both strategically and through individual stock selection. Emphasis on asset selection. And the portfolio is designed for the more cautious client who nevertheless wants to make sure that his money will keep up with inflation over time. On the right-hand side, there are two lines. The gray line is our target of inflation plus 4% per annum, going back almost 20 years ago as a fund manager of stable type funds. The dark blue line is my track record indexed of the stable funds that I have managed. You'll see that over time, the blue line is fairly stable. The only exception was in March 2020, the start of COVID, when all asset classes came down in a synchronized way and then recovered very quickly. And also over time, you'll see that we have kept the blue line above the gray line, i.e. our target has been met over time. If we look at the JSE All Share Index in red here, the price earnings ratio trailing at the moment is 10 times earnings, which is cheap compared to sparse. Now, I know many people tell you about load shedding, political uncertainty, and so on, but our stock market is cheap, reflecting all our problems. If we look at the USA, the S&P 500 index, the P ratio is fairly high, and that is with the USA likely to enter a period of either low growth or even possibly a mild recession next year. It looks expensive. If we look at South African inflation, which drives many of our decisions, you'll see inflation has rolled over. The last print, 4.7%, almost back at the center of the Reserve Bank's 6 to 3% target. It looks like inflation is back into target and should remain so, but a caution, there are some headwinds in terms of the Eskom price increases and other increases, which will feed into the numbers over the next few months. If we look at our bond market and compare that to international bonds, I have here the South African 10-year bond yielding currently over 11% compared to the US 10-year bond yielding 4%, a differential of 7%. South African investors are being well compensated for holding South African bonds compared to holding other developed market bonds. If we look at inflation linkers, one of my favorite asset classes, this is the I2038, currently yielding almost 5%, a very, very good asset to help us achieve our target of CPI plus 4% per annum over time. Going back to the USA again, the green line is USA inflation. It's come down rapidly. The last figure printed at 3.2%, not quite at the Federal Reserve target of 2%, but very close to it. The red line is short-term American interest rates, 3-month rate here at 5.5%, very high. In fact, the highest has been for decades. And that line we think is not going to come down in the short term. At the same time, I think we are getting towards a peak. As inflation comes down, the need for the Fed to hike rates further is reduced. We don't see rates in the USA coming down until maybe the second quarter of next year, but the need for them to climb further, I think, has gone. The problem for American interest rates is the unemployment, which remains near record levels. The US economy is still very strong. Until we see some deterioration in the USA economy, we think it's unlikely we're going to see cuts in US interest rates. If we look at the positioning of the BCI Sasfin stable fund, you'll see we have a full holding in equities at 27%. Property, we're underweight at 2.9%, and that'll come down further over the next few weeks as the Standard Bank Group has offered to buy out our shares in Liberty 2 degrees at a very nice premium to the previous market price. Fixed rate bonds, we remain overweight with a 23% holding. Inflation linkers, we also remain overweight We would have more in these asset classes, but for risk control purposes, we limit how much of an exposure we take. Floating rate bonds are at 9%. Foreign equity, 8%. We are cautious on international equities. Foreign bonds, we've increased recently to 4.5%. We think that US 10-year rates at about 4% offer good value long term, but we don't think they've peaked yet. If we look at our equity portfolio, our top 10 equities, at the top of the list, we have Naspers, up 11% so far this year, a price earnings ratio of 12. The bulk of this portfolio consists of Tencent, a Chinese tech company, which looks cheap, not without reason, but we think it offers great value relative to the risks in the stock. And the price earnings ratio of 12 here does not take into account the huge assets that Naspers has in various tech companies internationally, which are still loss-making. So that 12.5 PE actually substantially understates the true value of the portfolio looking forward. Remgro, 10 times earning, a good quality portfolio, including many clinic, South Africa's biggest fiber distribution business, and many other quality assets, trading at a 25% discount to some of the parts. Absa, one of South Africa's big banks, 6 times earning, incredibly good value, 8% dividend yield. We like high dividend yields. Adcock Ingram, the pharmaceutical company, just reported very good results, 9 times trading earnings, also a good dividend yield of 4%. Udeco, a smaller company, but with an excellent track record of producing earnings growth. Again, an excellent dividend yield of 7.5%. Raynet, Johan Rupert's offshore investment company. Biggest investment is in Pension Corp in the UK. And this trades at over a 40% discount to the sum of its parts valuation. Its big investment in Pensions Corp in the UK has just achieved some very big mandate gains. PPC Cement, 7 times earnings. We believe there's potential for growth in infrastructure in this country, and we buy it cheaply. Anheuser-Busch, the big beer company, slightly more expensive, but a rand hedge, and a quality business with good cash flow, which has reduced its debt substantially in recent years. Roynet, 7 times earnings, looking cheap, owns the big African cable operations in Africa. Cables will be needed if we want to increase transmission capacity in this country. And then ACI Limited trading at a very good 7p multiple. So really, we see this as a good diversified quality portfolio of equities offering great value with reasonable growth prospects in the years to come. I'll now hand over to my colleague who will discuss how we look at our equity investments.
Thank you, Errol. So I'll start off by showing our investment criteria, the circle of competence we look for when choosing to add a name to our portfolio. Firstly, that being a good management team, a management team that has been together for a while, a management team that has shown itself apt at deploying capital, a management team that has consistently delivered returns above the company's cost of capital. Being conservative investors, we would like that companies be lowly geared, that they have an acceptable level of debt that we can contend with, debt levels that will have us rest easy at night. Also, we look at companies with good growth prospects, good identifiable growth prospects. It's if you have high returns, but no growth prospects, surely these returns will be eroded. And then lastly, this company with a good management team that is lowly geared, company with good growth prospects, it must be supported by valuation. I will now go through how we apply this criteria in Bidvest. If you look at Bidvest, looking at it since the unbundling of Bidcorp, it has managed to achieve an ROE and return on invested capital above its weighted cost of capital, except for COVID, when some of the operations were not operating at full capacity. What is amazing about this company is that the maintenance of margins is reflective of the company that is able to pass on input and inflationary pressures. That ROE, or those returns you see there, are being driven by maintenance of margins and not so much leverage. Please go to the next slide. again, on our point of gearing, we prefer companies with debt levels that we can contend with. The company's debt levels, looking at this leverage ratio of net debt to EBITDA, is one that we can contend with. This also shows that the company will be able to apply a strategy of bolt-on acquisitions and support its growth going forward. If you go to the last slide, Errol. And then lastly, if you look at the valuation of the company, so based on our matrices, supported again by looking at where the company is trading relative to history. As you can see here, it confirms what we believe that the company is fairly valued. I'll hand over to Errol.
Thank you. Our main objective with the Sasfin BCI stable fund is to produce stable returns over time which beat inflation. We don't usually compare ourselves to our competitors, but if you look at the range of the CISA competitors, you'll see that over rolling 3 years, the Sasfin BCI stable fund, despite a conservative profile, has tended to remain mainly in the top quartile and certainly in the top half of the rankings compared to its competitors. I think there are over 150. If you look at risk and return and the Sasfin BCI stable fund, the four charts here from top left to bottom right are 3 years, 5 years, 7 and 10-year records. We aim to be in the top left quartile. If you look at the vertical axis, higher return, top left there, you'll see it go from 0 to 16% per annum. We won't prefer higher return, so we're going to be towards the top. And risk increases towards the right. We want to be towards the left-hand side of the graph. And you can see over all periods shown here, the blue dot, which is the Sasfin BCI stable fund, is showing a high return and low risk compared to its competitors. And that's what we aim to do over time, produce good, solid returns for our clients, but with low risk. Thank you very much.